Hi there. If you're a high income W-2 earner looking for ways to reduce your taxes, short-term rentals just might be the answer that you're looking for. We're going to break down how short-term rentals can help you save up to 5 to 6 figures in taxes in this video, so make sure to stick around. Hi, my name is Thomas Castelli, and I've helped hundreds of real estate investors, business owners, and high income earners reduce their taxes by using the tax code to their advantage. I do have a free newsletter with additional tax tips in the description to this video, so make sure to subscribe to that if you do want more ways to reduce your taxes. Also, be sure to subscribe to the channel because I'm going to be releasing 2 to 3 additional videos every single week with tax tips, so you don't want to miss those. And lastly, if you do have any questions throughout this video, make sure to drop me a comment. I'm going to be answering as many questions as possible. But without further ado, let's just jump right into how short-term rentals can help W-2 earners reduce taxes. All right, so let's lay some groundwork here, okay? So the tax code tends to favor business owners and real estate investors and doesn't leave many options for W-2 earners to reduce their taxes. And the ones that are typically mentioned, you probably already heard of, like retirement account contributions, charitable contributions, mortgage interest deductions, property tax deductions, HSAs, perhaps some student loan deductions, some minor things like that, all right? But if you're looking for real powerful ways to reduce your taxes as a W-2 earner, you are limited. Now, you may have heard of real estate. The problem is if you're earning more than $150,000 or you're not able to qualify as a real estate professional because you're not working full-time in real estate, it can be limited, and you often cannot use real estate to offset your W-2 income because the losses that are generated by the non-cash expense called depreciation will only be able to offset other passive income, which in many cases are just other rental properties. Nice, efficient bucket to build tax-efficient wealth, but will generally not help you with your W-2 income. Now, this is where short-term rentals come in, okay? And this is why short-term rentals are so powerful. So short-term rentals are often treated as a business under the tax code and not real estate, which means they are not passive by default, okay? And these rules were put in place primarily for hotels and motels, but can now be applied to short-term rentals thanks to Airbnb, VRBO, things like that. All right. And in order to make this work, you need to have a property that you rent out for an average period of customer use or an average guest stay of 7 days or less for the year. Not just 7 days or less one time, but 7 days or less on average for the year. Okay. And you have to materially participate in your short-term rental business. Now, to qualify as a real estate professional and take losses from your long-term or your mid-term rental properties, you need to spend more than 750 hours and more than half your total working time in a real property trade or business. And if you have a full-time W-2 job, this is typically considered somewhere between 2,000 to 2,080 hours per year, and you'd have to work double that, or 81 hours every week for the entire year to make the real estate professional status work for you. And between IRS audits and tax court cases, it's proven virtually impossible to do. The IRS has figured this out. This is not something you want to go to battle on. So this is why the real estate professional, this is why the short-term rental loophole, is a better strategy. Okay, because again, 7 days or less on average for the entire year, relatively easy to achieve thanks to Airbnb and VRBO. So let's go ahead and check that box. Okay, now materially participating is not 750 and more than half your total working time. It's meeting one of 7 tests, with 3 of them being the most relevant. Okay, the first one is going to be you spend more than 500 hours managing your short-term rental for the year. The second one is that you do substantially everything or substantially all of the activity or all of the work for that short-term rental property with very little to no outside help. So you're typically a one-person show in that case. Or you spend more than 100 hours and no one else spends more time than you. Now, this last one, the 100-hour test, we'll call it, where you're spending more than 100 hours on your short-term rental and no one else is spending more time than you, is by far the most popular test to use for this, because you can run the pricing, you could communicate with guests, things like that, and still delegate to cleaners and repair people to help repair and maintain the property while you kind of just run the show part-time, okay? So this is why short-term rentals are it's like the big key for W-2 earners, because in order to make this strategy work, you need to have an average period of customer use of 7 days or less, okay? And then you materially participate by meeting one of the 3 tests. Boom. Once you do that, the losses are now non-passive and can offset your W-2 income and other forms of income, all right? So that's That's the first step here. Now, that's all well and good, but how do you really turn up the jets on this strategy? Well, this strategy works by, again, using the losses from your rental property. So how do you generate these losses? Well, it's thanks to the non-cash expense called depreciation, which we've talked about in other videos here on the channel. But this non-cash expense called depreciation often causes a loss for tax purposes, despite the fact that you might be generating cash flow. And there's ways to accelerate or increase this expense in the first year you own the property, and that's thanks to something called bonus depreciation. So you have your short-term rental property, and you go ahead and get something called a cost segregation study performed, which breaks down the various components of your property into their useful or their depreciable lives. And all the property with a depreciable life of 20 years or less, which is somewhere between 20 to 30% of the property's value in many cases, can be depreciated significantly in that first year, creating a large loss that can be used to offset the taxes you're paying on your W-2 income. All right. So, and what do I mean by offset? Okay. This loss from your property is not offsetting your taxes directly, but offsetting your income. So for example, if you made $500,000 in income and you had a short-term rental property that generated a $100,000 loss thanks to bonus depreciation, then you would only pay tax on $400,000 of your income, okay? And this often leads to substantial tax savings. So let's go ahead and summarize how this works, okay? So first things first, the tax code tends to favor business owners and real estate investors. And we're going to disregard business owners here for this case, but that leaves us with real estate. The problem is with real estate is that losses from your rental properties are going to be passive by default and can't offset your W-2 income unless you can use the special loss allowance, the real estate professional status, or the short-term rental loophole. Now, the special loss allowance is out for many high-income earners earning more than $150,000 per year. And the real estate professional status really is very difficult to achieve if you have a full-time W-2 job. So this leaves us with the short-term rental loophole or or investing in short-term rentals, okay? And the way that works, again, just to summarize it, you have an average period of customer use of 7 days or less for the year, and you materially participate by meeting one of the 3 tests that I mentioned in this video. And also, you go ahead and use cost segregation and combine it with bonus depreciation to create large non-cash losses that can be used to offset your W-2 income and substantially reduce your taxes. And the bonus benefit of this is that if you invest in short-term rentals the right way and you buy properties in the right markets, you could generate substantial amounts of cash flow and help build your wealth at the same time that you're helping yourself reduce taxes, okay? So that is why short-term rentals are so powerful and provide such big benefits to W-2 employees. So if you have any questions about the strategy and how it works, go ahead and drop me a comment. I'm going to be answering as many comments as I can to help you reduce taxes. And also, if you do want to sit down with a CPA and tax strategist to help just pinpoint, so you can shortcut the learning curve and pinpoint exactly what you need to do for your situation to help reduce your tax bills and save you a whole bunch of time and energy trying to figure out yourself, I do invite you to request a free discovery call with our team. The link is in the description to this video. We'd be happy to learn more about your situation and how we can help. That's it for today. Thanks for watching, and I'll catch you on the next video.